What is your take on the decision to set a GDP target of above 6%, but drop any numerical target from the 5-year plan? What does it tell us about the kind of quality growth, the quality of the growth that officials here, lawmakers here are trying to pursue?
I think that's the key point, Tom. You know, last year, most analysts expected growth to be negative, and at the time I argued no, it was likely to be between 2 and 3%, mostly because quality growth contracted, and they're using fixed asset investment, which they don't want to use, as sort of a residual to achieve whatever the GDP growth target is that they think is politically important. This year, while most analysts were talking about 8 to 10% growth, since December, I've said no. They're going to partially reverse some of the damage that occurred last year, and they would probably settle for 6 to 7% GDP growth this year. In fact, I think that's a much better number than 8%. I think if they had gone for 8%, that would have been a terrible signal. 6% is manageable this year with high quality growth. Anything else requires a significant increase in non-productive investment and, of course, in debt.
Well, absolutely. And what you point to, Michael, Professor, is, of course, that quality of growth, the makeup of that growth. Part of that, of course, and there's been a focus on this from lawmakers and officials here, is driving consumption as part of this dual circulation policy. Where are we in the recovery of consumption here in China?
Well, over the longer term, we haven't advanced at all. In the short term, we're going to get a partial recovery of the increase in the household savings rate that occurred last year. When you can't go out and spend money, you're forced to save more. Some of that will come back in the form of higher consumption. But basically, the model hasn't been fixed. We're stuck with low consumption until we manage a significant redistribution of income.
Okay, that then, excuse me, Michael, takes us into the debt issue. I mean, the debt issue, or how do we put it? The analysts making debt an issue in China has been there, I think, as long as the economy started to open up. It's never really resulted in a market event. Is that something we should still worry about, though, looking at the next 5-10 years?
I'm sorry, I'm getting you. I'm getting you very badly. But if I can understand your question, the longer-term growth really depends on a number of things. And as part of the dual circulation model, they've argued that they want domestic demand to drive growth, which is really consumption. But in order for consumption to drive growth, as is well understood, you have to allow household income to grow much more quickly than GDP. But by definition, if household income grows more quickly, then the government share and the business share, probably the government share, must grow much more slowly. And I would argue that this is really a very important political transition, which they've been talking about for more than 10 years, but have been unable to do.
Is that something then that actually falls within the control of the government? Because that takes you into things like tax policy, the 4 funds, for example, social security nets, what have you. What does the government need to do as far as those things are concerned to further that objective that you just laid out for us there?
Well, just to give you an idea of the arithmetic of the transition, household consumption in China is maybe 35 to 40% of GDP, and the rest of the world is slightly above 60%. So we're talking about a 20 percentage point difference. Now, imagine that household income in China is roughly half of total GDP, the other half being business and government. So it's on parity, roughly. If you want household consumption to rise by 20 percentage points, you'll need the household share of GDP to rise by at least that much. And so the government and business share to decline by at least that much, which means you have to shift from a country in which households are roughly on parity with government and business to a country in which households have roughly 2 to 3 times the share that governments and businesses do. And that's really easy to say. The arithmetic is simple. But I would argue that the politics is very, very difficult and requires significant transformation of political institutions, which they're still struggling with.
Arguably, one lever that would help those households expand their wealth would be opening up the capital markets, and we know that that has been a focus. It's been a gradual push that we've seen over the years. Is there one thing that you're looking out for that they may enact, one policy change to spur a further and more rapid opening of the capital markets here?
Well, I think they're opening it up about as fast as they dare at this point. With so much foreign money coming into China, total foreign outstandings are still quite small. So we're not at major risk now. But if this continues for a year or two, we will see a much bigger foreign presence within the domestic capital markets, which Beijing is trying to match by encouraging capital outflows. You'll have noticed since November, a whole series of measures aimed at encouraging capital outflows. But that, of course, creates a very different type of risk because the money that comes in is not in any way indexed to the money that leaves. So that creates balance sheet mismanagements. And already we've been seeing, particularly with Guo Shuqin's speech earlier this week, that Beijing is starting to worry a great deal about the financial stability consequences of a significant opening of the capital markets. As I said, I don't think that'll be a problem this year, but I think beginning next year or thereafter, we have to start watching very carefully the composition of inflows and outflows.